Now, what about ETFs? What are ETFs? Let me see. How can I remove my connotation here? Clear drawings. There you go. Okay, what is an ETF? We hear a lot about ETFs, okay, which is short for Exchange Traded Fund. If I'm going too fast, guys, let me know, okay? Because this is we need to understand the basics and go from there. So ETF is an exchange traded fund. It's a fund that has different shares in it, okay, that is managed by a company. It could be real estate, it could be stocks, it could be bonds. I'll show you examples of it to clarify, but basically it's like a shopping cart which has a bunch of shares in it, stocks in it, and it becomes like a portfolio, and then you invest in this portfolio. They are traded on a stock exchange very much like stocks, okay? They are traded very much like stocks, and therefore that's why it's called an exchange traded, because it's traded on an exchange, but it's a fund. It's not one stock, it's a bunch of stocks together. Okay, is it clear what an ETF is? And their price, same as stocks, will increase and decrease similar to a stock. Okay, awesome, clear, great, great, great. Okay, now ETF versus stock, to clarify more. When you are starting, if you are a new investor, it's better to invest in a market ETF. Why? Because it's diversified for you. It has different shares instead of putting all your eggs in one basket in one stock. So when you invest in one stock, over here you are investing in Microsoft, for example. You're putting all your money here in Microsoft, okay? So God forbid something happens to Microsoft, you lose your money. But here, if you put it in an ETF, then your money is diversified over a bunch of shares. You're owning a percent of this portfolio. Now, VOO, for example, this ETF is the S&P 500 ETF. What that means is that it has the top 500 companies in the US as part of this portfolio. So when you invest in it, you're investing in all of those 500 companies through that one ETF that you're buying. Okay, what that means is, and just to let you know that the S&P 500 index is rigged to keep the top 500 companies. So like NVIDIA, for example, as it became more valuable and had more market cap, it became one of the top and it got included into the S&P 500, while a weaker company gets kicked out. Okay, so it's every quarter they check the companies that their market cap is growing. They are the top 500, they get included in it, and the weak companies that are losing market cap, that are losing market value, are kicked out. And that's why it's called that it's rigged to continuously increase over time, and is considered one of the safest ETFs. I mean, of course there is risks involved, but it is safer to put your money in a market ETF than one share if you are just starting investing. Okay, is that clear, guys? Awesome, awesome. Okay, so what are the top 10 ETFs? As you can see here, we have the SPY, which is the S&P 500. I'm trying to see, where's my mouse here. Okay, the S&P 500. Then you have the VOO, which is also S&P 500. The VTI is a total stock market index. The QQQ is NASDAQ, which is the tech companies. And then you have the VUG, which is the Vanguard, the growth. Let me see, where's my mouse here. Okay, and then you have these ETFs, and I've put here for you on the right for people who are interested in Sharia compliant ETFs. If you are someone who is interested in the Sharia compliant, then you have the SPUS, is the one that is similar to the S&P 500. So instead of buying the VOO, you would put your money in SPUS if you are looking for the Sharia compliant. I mean, take a screenshot of this screen if you'd like, so that you have the Sharia compliant ETFs if that's what you're more interested in. And then beside it, you have the top 10 most popular ETFs. Based on asset under management. What does that mean? Asset under management, how much money they've put in, how much they've bought, and how much is valued at the moment. That's what AUM, asset under management, means. Then you also have this thing called expense ratio. Because this is a fund that is managed by a company, it's created by a company, there is a fee. You don't get an expense ratio on stocks, but you get expense ratio on ETFs because they are funds that is created by companies. Like the Vanguard, for example, those are created by Vanguard. You have Schwab that creates as well. You have Fidelity and so forth. So they are going to charge expense ratios. Normally, always look for the lower expense ratio. Okay, so 0.03, 0.03 are pretty good expense ratios. Now, why does QQQ charge 0.2 and people still invest in it? Because it's a risky one and the growth is really much higher than the VOO. Okay, because it's all tech. And these are the 10-year returns. As you can see, there you go. So the QQQ has a higher growth, even with the expense ratio, than the others. The average for the S&P 500, we used to say 8 to 10%, but it has exceeded that right now because the top 500 companies have become tech, and a lot of them are in AI, and the growth has become exponential. So the last 12-year return of the VOO was 12.6, for example, and the IVV 12.92. Okay. Usually the Sharia-compliant ETFs have a bit of a higher expense ratio as well. So do have a look at those. This is example of the holdings, what companies. If you want to go and look, this is from Yahoo Finance. You would just type yahoofinance.com. You would type in your symbol for your ETFs, which in this case is the VOO, the S&P 500, and it will give you the top 10 companies that are in there and the sector weighting. So it's very heavy in technology. It has financial services, healthcare, and so forth. And you can see on the left here, those are the main holdings of the companies, Apple, Microsoft, Nvidia, and so forth, and what percent they own in each. Okay,